Chapter 11 will be on real estate investments and business opportunity brokerage.
There are some important issues that we need to talk about before we get started into this. First of all, let's do a quick review about investment analysis and cash flows. First, we're going to have potential gross income. Remember that potential gross income is the maximum money that a property can possibly generate under the very best of conditions, and that is if it's 100% occupied. And there's two ways that we calculate potential gross income, either through market rent or contract rent. From there, we subtract out our vacancy and collection losses. Those are folks that are simply not there or can't pay. That will give us effective gross income. Remember that effective gross income is the actual money that we have to pay our bills with. And those bills are called operating expenses. The operating expenses really fall into three categories. Fixed expenses, which are your real estate taxes and property insurance. Variable expenses, which are maintenance, management, and utilities, and things of that nature. Things that are going to fluctuate with occupancy. And then the last category is going to be reserves for replacement. We're setting money aside to pay for things that may break later on. Once we subtract those out, that's going to give us net operating income. It's the net operating income that the appraiser uses in the formula to try to determine value of property. But from an investment analysis, we want to carry that a little bit further. If you'll remember, I said that your mortgage payment or your debt service was not considered to be an operating expense. So from our net operating income, what we're going to do is subtract away our mortgage payment. Another word for mortgage payment is debt service. That will give us something called cash throw-off. Cash throw-off is your before-tax cash flow. In other words, that's the money that we actually get to put in our pocket before we pay our income taxes. Then once we calculate our income taxes, subtract that away, that leaves us after-tax cash flow. Also, an important concept in investment analysis is something called leverage. In the majority of the cases, anytime that a person can borrow money, leverage in other words, the investment in terms of the return will be a lot higher. So when we're talking about leverage, all we're talking about is borrowing money for an investment. And you know, leverage can be either positive or negative. If we borrow money at 5%, we invest it and we can get a 10 or 12% return, that's a positive leverage. If we borrow money at 5% and invest it and can only get a 2% return, that's considered to be a negative leverage. Also, another important concept that we need to understand is what capital gains are. A capital gains means that you made a profit from selling a capital asset. A capital asset is anything that we've bought for income, business, or investment. So when we sell it, the question is, did we make money or did we lose money? As far as equity is concerned, equity, typically speaking, is considered to be our down payment. Another way to look at equity is the difference between what a property is worth and what our mortgage is. The difference between liquidity and marketability is important. Everything is marketable. Everything can be sold at whatever the current market value is. Liquidity, however, means being able to sell something and get your money back in a fairly short period of time, within a year. As far as advantages of investment real estate, there are a number. One is a good return. Again, that has a lot to do with another advantage, and that's called leverage. Leverage typically creates that a positive return. Also, there are some tax advantages, and there's also equity buildup. And when I talk about equity buildup, what I'm saying is that as time goes on, hopefully the property is going to go up in value, hopefully, and at the very same time we're paying off our mortgage balance. And as those two occur at the same time, our equity grows in the property. As far as disadvantages, there are several disadvantages, and we've discovered that lately. Probably one of the biggest is illiquidity. Just because we paid a certain amount of money for a particular property doesn't necessarily mean we'll be able to sell it for that. In fact, sometimes we don't get our money back when we invest. Another big factor that we have to consider is management fees. Oftentimes, if our cash flow is real close and we have to pay a property manager, that creates an issue in terms of our cash flows. As far as risk is concerned, anytime that you buy real estate, there's going to be risk. Probably the biggest risk that we deal with is something called business risk. Business risk simply says that if we are anticipating a certain cash flow, that we're anticipating a certain net income, what if our vacancy rate goes up? What if our operating expenses go up? Then that may impact that bottom line, that net operating income. So business risk always is going to play a role in this. Also, one other is financial risk. That is to say that if we are looking to borrow money, is it available? Sometimes the market is agreeable, sometimes it's not. Currently, getting a loan on certain types of properties are very difficult to do. So financial risk is also going to be an important factor that we have to deal with. As far as cost, price, and profit, I want to make sure that we understand that oftentimes when we have a certain cost or a price that we pay for a property, the question is, what is our profit? There's a formula that I want you to remember. It's called made over paid. It's a profit percent formula, and it's always going to be on the examinations, always. And it simply says is that what I made, in other words, my net return after I sell it, as it relates to how much I paid for it. In other words, the example in the textbook, you pay $125,000 for a property and later sell it for $150,000. Well, the paid part is the $125,000. The made part is, what was my net profit? Well, $150,000 minus $125,000 equals $25,000. So what I made was $25,000. As it relates to what I paid, which was $125,000, then what is the percent of that? And by the way, that can also be a positive or negative as well. An important issue that we need to talk about right now is the nature of business brokerage. And what we can say is that in the state of Florida, in order for you to practice business brokerage, that is selling going concern operations, such as a restaurant, such as a bookstore, whatever that might be, that in most cases, the sale or the transfer of real property is going to be involved, which means that it's going to be either a sale or a lease, which means there's going to have to be a real estate license involved. So for all practical purposes, that when we're acting as a business broker, we need to have a Florida real estate license in order to do that. And so when we look at the similarities and the differences in the two between a business broker and a real estate broker, obviously both have to understand how to price out real property, whether it's a CMA and a sale or whether it's a lease. So understanding the real estate market is very important. On the other hand, one of the biggest differences is that most of your business brokers need to understand financial calculations such as balance sheets, profit and loss statements, and those kinds of things, where the average real estate licensee or real estate broker doesn't deal with things of that nature. So there are some differences. Anytime that we are going to appraise a business, what we're going to do is we're going to use the three approaches that we use in real estate. That is the comparable sales approach. We're going to look at other businesses that have sold recently. We're going to look at the cost depreciation approach. In other words, what would it take for me to rebuild this business just like it is brand new, and then subtract out for whatever depreciation has occurred. Another approach that's similar to real estate is the income capitalization approach. That is looking at the property's net income and applying some predetermined capitalization rate to come up with value. So those three approaches are going to be similar for both real estate and for business brokerage. But there's one approach to business brokerage that is unique only to business brokerage that we don't deal with in real estate. It's called the liquidation value approach. The liquidation value approach simply says, let's take all of our assets, let's sell them, let's pay off all of our liabilities, and whatever is left over, that's going to be the minimum value of the business. That's the liquidation value approach. Otherwise, appraising a business is not that much different. I will say this, though, that business brokers have to understand what assets and liabilities are, what the various kinds of goodwill are, where in real estate, in regular real estate, we don't have to understand that. With that said, why don't we go ahead now and do a quick review and make sure that we understand these concepts. First of all, the advantages of real estate. There's a good return. There are tax advantages. We're able to borrow money, which is called leverage. And as a result, we hope there's going to be some type of equity buildup. As far as disadvantages in buying real estate, remember that illiquidity has been a big problem that we've had. In other words, not getting our money back that we invested. Also, we have big management expenses in some cases. As far as leverage is concerned, leverage is borrowing money. And in most cases, the more we can borrow, the less we put down, the bigger the return on our investment. Remember also, there are risks involved in buying real estate. Business risk has to do with income being lower than expenses. Financial risk means that there probably are not funds available to finance a property. As far as business brokers are concerned, they have to understand financial data. Remember that the liquidation value approach is unique only to business brokerage.
And this is the end of this chapter's review.